The firms are obliged to apply a wide range of financial practices covering various manipulations in managing their finances. These methods are the way in which the management controls its finances. All these processes are targeted to ensure continuity and development of the company concerned. It also encompasses budgeting, financial forecasting, cash flow management, investment, and protection of liquidity with operational efficiency. Even financial forecasting falls under this category. Each subcategory of managing money is significantly vital concerning the overall financial health of the organization. This can help keep the company competitive in an always unpredictable economic climate. Budgeting is one of the major processes entailed. For this to be achieved, there is a need to develop a financial plan. This should also give definite data as to the expected revenues and expenses within a certain period, usually within a fiscal year. By having a budget, businesses could allocate their resources accordingly, decide on what they should spend the money on first, and therefore make a correct decision on how to proceed with their expenses for the future. It is a method that supports businesses in making estimations about future revenues, expenses, and capital requirements based on the data available at the time. As a result, businesses can be in a better position to strengthen their operational processes in relation to future financial opportunities and challenges. Forecasting is a process used to predict future financial performance by utilizing a number of various approaches: statistical analysis, market trends, and the insights of professionals in the given industry. Should proper forecasting be conducted, it has the power to empower decision-making and enable a business to make rapid adaptations to dynamic market conditions. Besides being essential, cash flow management is the second most crucial part of financial management activities of a company. Cash flow refers to the inflows and outflows that enter the business from different activities of financial type, investing, and operational activities of the business. In this case, efficient cash flow management is supposed to enable the company to meet its short-term obligations such as paying its suppliers, payroll, and debts, while it still maintains sufficient liquidity to exploit opportunities or mitigate unexpected expenses. This is because effective cash flow management enables the firm to meet its short-term responsibilities. Businesses are always concerned about their cash flow to prevent possible liquidity problems that will disrupt their operations. Cash flow is what businesses look at constantly. Businesses look at a mountain of available tools to get a read from and improve the flow of cash within operations, from cash flow statements or projections. The inability of a firm to manage its working capital, usually defined as the difference between current assets and current liabilities respectively, would oblige the business not only to cope with its current cash flow but also to manage their working capital. That is a must for businesses. The capability of a firm to ensure that it has sufficient short-term assets and meet its short-term obligations is one of the most critical parts of successful management of working capital. This would involve an effective management system for realizing efficiency in all three levels of inventory, accounts receivable, and accounts payable. Businesses try, in summary, to shorten the time taken between the sale of goods or a service and the time taken to receive money, while at the same time negotiating receipt-friendly payment terms from suppliers. Reaching this balance ensures that the organization will experience no hindrances to its functions and will not suffer from any shortages in funds. Another aspect to be discussed is that investments form the basis of any corporation's financial management. Companies invest in capital goods like land, equipment, technological advances, and human labor in the hope of reaping benefits from these inputs in the long run. These investments are made to raise their competitiveness. Besides, through the investment of excess cash in various financial instruments like stocks, bonds, or money market funds, businesses can earn extra income. This is done to ensure that they reap more income. For doing so, the proper management of these assets requires an adequate risk and return analysis at the initiation. This, thus, is a very important decision which businesses have got to make to identify whether an investment is aligned with the overall financial goals and what the actual impact of it would be on liquidity. For instance, if you make terrible decisions regarding investments, you can wind up with losses. But if you make excellent choices pertaining to investments, you can wind up prospering well into the future. Aside from being an important factor in financial management, management of debt positions also has to be tended to with caution. Whether it be for operation financing, investing in expansion, or temporary cash flow difficulties, firms are often put in situations where they need to look upon borrowings of money for support. For managing debt appropriately, the going concern is supposed to be in a position to be able to meet its liabilities without overstretching the resources and means of the company. This becomes necessary if the debt is to be decently managed. It involves the selection of the right type of financing that could be in the form of loans, lines of credit, or even bond sales. In addition to this, negotiations about favorable interest rates and repayment conditions are performed simultaneously. Maintaining the proper debt-to-equity ratio is something highly essential for organizations. Excessive debt is associated with an increase in financial risk and a decrease in profitability. At the same time, too little debt means forfeiting growth opportunities. Apart from being an integrated part of finance management, tax planning is also an essential factor or ingredient. Understanding the rules and regulations associated with taxes properly will help a business firm maximize their after-tax earnings and reduce tax burdens. In that regard, making strategic decisions on deductions, credits, timing of expenses is very important. With efficient tax planning, the company will have cost savings substantially, thereby enabling the firm to reinvest those cost savings into other aspects of the business or to maximize its profitability. The other main area that needs to be considered within financial management encompasses risk management. The companies are usually exposed to many types of financial risks, such as market variations, changes in the interest rates, variations in currency exchange rates, and credit risks. Other kinds of financial risks involve fluctuations in currency exchange rates, financial derivatives such as options and futures contracts, as well as the diversification of the investment portfolios, represent two of the common means whereby companies seek to shield themselves from the risks they experience. As an additional business interest, many businesses apply for insurance policies to cover them against certain risks such as property destruction, liability, and injuries sustained by its employees. Long-term, businesses must place compliance and financial reporting procedures at the forefront. This also involves the presentation of correct and accurate financial reporting, which is critically needed both internally in decision-making within an organization and externally with such stakeholders as investors, creditors, and regulatory agencies. Businesses are obliged to compile their statements of account in line with standards underlying accounting. These mainly include the income statement, the balance sheet, and the cash flow statement. For the purposes of luring investors, borrowing, and raising capital, these reports have to provide an honest picture that reflects the true structure of the company's financial status. These reports are meant to reflect this picture. Businesses have to adhere to various financial regulations so as not to face legal repercussions and also to uphold a good reputation. These include statutes relating to taxes, the standards of reporting financial information, and also those rules which are specific to that sector only. In short, money management within a company encompasses various activities that are interlinked as well as multifaceted. It requires a lot of meticulousness in planning and analysis for such kinds of activities to be carried out. Budgeting and forecasting are also part of enhancement in the financial health of an organization, besides cash flow management and debt management. Cash flow management and debt management in itself is an important aspect. Where businesses ensure that their financial management is effective, they will be capable of achieving their goals and maintaining the lead, besides overcoming the various challenges that the market places before them. Thanks for watching. Don't forget to like and subscribe to our YouTube channel.